back to our 15 minutes tax savvy small business life, where we talk about very real strategies that help business owners and investors legally keep more of what they earn instead of sending it to tax. Today we are talking about something that surprises almost every real estate investor the first time they hear about it. It's the depreciation recapture. And honestly, this is one of those moments where investors look at me and say, wait, nobody ever told me about that part. Of course, here is the reality. Most investors absolutely love depreciation, and for the good reason. Depreciation can create huge tax benefits, deductions every single year, even though you don't actually spend that money in cash. It's one of the tax benefits real estate offers. You buy a property, you rent it out, and every year the IRS allows you to deduct a portion of the building value as depreciation. So your taxable income goes down. Your tax bill goes down, and everyone is happy, especially if you have done something like a cost segregation study, which can accelerate that depreciation and create even bigger deductions in the early years. But here is the part most people don't hear about when they first start investing. When you eventually sell the property, the IRS come back and says something very important. They say, remember that depreciation you took over the years? Well, we want to settle up. That's what depreciation recapture is. It's essentially the IRS saying that the depreciation deductions you took reduced your taxable income over the years. So when you sell the property, part of that benefit gets recaptured. In simple terms, a portion of your gain gets taxed different. And for many investors, that tax rates can be up to 25% on the depreciation portion. Now, let me give you a simple example because this is where the light bulb usually goes on. Let's say you bought a rental property for $500,000. Over the years, you claimed $100,000 of depreciation deductions. Those deductions saved you real tax money every single year. But then one day you sell the property. When the sale happens, that $100,000 of depreciation you previously claimed doesn't just disappear. That amount is what we call recaptured depreciation, and the IRS taxes that portion separately when you sell. In addition, so investors who thought they were only dealing with capital gains suddenly realize there is another layer of tax involved. And this is exactly why exit planning matters just as much as deduction planning. Because maximizing deductions during ownership is great. But if nobody talks to you about the exit strategy, you can walk straight into a tax surprise later. Now, here is the good news. Depreciation recapture is not something you just have to accept blindly. There are actually 7 strategies investors use to manage it. One of the most well-known strategies is a 1031 exchange, where instead of selling and paying tax immediately, you roll the proceeds into another investment property that can defer both capital gain and depreciation recapture. Another approach is timing. Sometimes investors coordinate the sale of property with other losses or other tax planning strategies that help to offset the gain. And in some cases, long-term portfolio planning can significantly reduce the tax impact over time. But the key point I want you to take away today is this. If you're taking depreciation on real estate, which you absolutely should be doing, you also want to understand how it affects the day you eventually sell. Because the biggest tax surprises usually happen when people focus only on today's deductions and never think about tomorrow's exit. And this is actually why tax planning around real estate is so powerful when it's done proactively instead of reactive. When investors plan early, We can structure things in a way that protects both sides of the equation, the deductions today and the exit tomorrow. Also, a lot of investors think they can avoid depreciation recapture by simply choosing not to claim depreciation in the first place. Unfortunately, the tax law does not allow that. The IRS calculates recapture based on the depreciation you were allowed to take, not just what you actually claimed. So even if you skip the deduction, the recapture tax can still apply when you sell. Now, if you want to see how this might affect your own properties, I put together a very simple worksheet that helps you to estimate your potential depreciation recapture exposure. It walks you through the numbers step by step so you can start seeing what the future tax picture might look like. I will DM it to you if you comment recapture, even if you're watching it on replay. And if you own rental properties and you are not sure whether your tax strategy is actually optimized yet, this is exactly the kind of conversation we have with our clients every day. Because the goal isn't just saving taxes this year. The real goal is building a long-term strategy that protects your wealth as your portfolio grows. And thanks for joining me today for this 15-minute tax savvy small business live. And next week, we are going to continue with another real estate topic that a lot of investors misunderstand, especially when it comes to taxes and long-term planning. So make sure you follow the page so you don't miss it. And always keep building smart.